certainly India is continuing to accumulate gold, and maybe it's just too new and hasn't really broken out into something more than some skirmishes. Maybe if it were to become evident that this is getting very scary, it would, and it should. I mean, look, in the West, the market is too reactionary. You could argue that the folks in India and in China and that part of the world have been accumulating so much gold and silver for so long that it has less of an effect over there than it normally would. It should manifest itself here. And what do we see instead? We see people moving away from the risk off trade into the risk on trade. And it just goes to show that the masses are typically always in the wrong place at the wrong time. And that's why guys like Rick Rule, who have made a fortune, have done so as being a contrarian. And he's famous for saying, if you're not a contrarian, you'll be a victim. Well, right now, that is kind of what the world is saying. And I wouldn't look to the gold price, which has been for a very long time managed for several reasons, although I would argue that they've lost the ability to manage gold. Not yet silver. I would argue that China is controlling gold more than the West is ultimately. And so, rising gold is something that doesn't benefit any of these players really rising gold yet until the final resolution or the final understanding that if you don't get whatever isn't nailed down, it's too late. Well, we're not there yet, but I wouldn't look to that. I think that's maybe slightly misleading, and maybe it's not as severe as we are being led to believe, since there is a pause. Cooler heads are prevailing. Let's hope. But everything that I've ever noticed about war, Guy, is that we would think the price should be going higher, and the players that like to manage its price, well, they will delink that rationale. They will delink the people's belief that when things get scary, you should run to gold, and they do it by shorting the paper price. And it kind of, don't look here, just keep on walking. And I would, China's involved in that too. They want to continue to accumulate as much gold as possible. So by shorting the price during these conflicts, or not allowing it to run quite the way that it should as a result of it, makes people think, maybe I should buy Bitcoin instead, or buy something else. At the same time, they're doubling down their own accumulation efforts off of a lower price. So that's been kind of part of the playbook for a very long time, and ultimately will accentuate itself. But the immediacy, and that's just it. People in this country are always looking for a reason. Well, the market went down because, for this reason. Oh, well, that's great. Now I feel better. There's a lot more to all of this than just something like a skirmish between two angry nuclear powers. That's bad enough as it is, but maybe if it broke into something far more frightening, we would see gold finally start to move as a result of that.
Let's talk about the elephant in the vault again. And I don't mean inflation, war, or rates. I mean gold, and more specifically, what's being done with it and by whom, while most of the West continues to sleepwalk into the next financial upheaval. Right now, as we speak, India is quietly accumulating gold, and they're not alone. China, Russia, Singapore, Turkey. It's a parade of global actors all adding to their gold holdings quarter after quarter. But for some reason, that hasn't yet fully registered in the Western mindset. Why? Well, because we're too reactive. We wait until there's a crisis to ask questions. The East? They plan decades ahead. They've been slowly, methodically accumulating gold and silver while we chase tech stocks, meme coins, and transitory inflation narratives. And what happens when the world catches on? Gold doesn't walk higher, it erupts. Now, to be fair, maybe what we're watching right now is just some geopolitical saber rattling, some skirmishes, some sanctions, some threats. Nothing's blown up yet. So perhaps people are telling themselves, let's stay in the risk trade. Buy the dip, don't fight the Fed. And sure, maybe cooler heads are prevailing for now. But here's the kicker. Gold should have already priced this in. The mere threat of war, nuclear tension, global financial fragmentation. Historically, those were enough to ignite a massive flight to safety. But not now. Not anymore. And that's not because the risk isn't real, it's because the perception is being delinked. What I mean is this: the price of gold isn't allowed to reflect the true level of risk. It's managed, it's gamed, it's deliberately suppressed to sever that psychological connection that says crisis equals buy gold. And this is not some new phenomenon. It's the playbook, and it's been in place for a long time. When the world gets scary, the price of gold should explode. But it doesn't. Why? Because the big players, both West and East, want to accumulate more gold before the reset, before the new system, before the repricing. And to do that, they need the price low. So what do? They suppress the paper markets. They flood the COMEX with shorts. They pound the price during major headlines, even war, to confuse people. Make them think, well, if gold's not going up now, maybe it's not such a good hedge after all. It's psychological warfare, and it works. The masses have no idea what's going on. They just see gold getting hit when the headlines are screaming geopolitical risk, and they walk away. They move to risk assets. They buy tech, crypto, or sit in cash. And all the while, the smart money, the sovereigns, the elites, they're scooping up metal like it's the final sale at a liquidation auction. And the retail investor? They're always late, always distracted, always moving into the wrong asset at the wrong time. Look, Rick Rule said it best. If you're not a contrarian, you'll be a victim. That's not just a catchy phrase. That's a lifestyle. That's a philosophy. Right now, the contrarian trade is gold. It's silver. It's hard assets in an environment built on lies, leverage, and illusion. But people aren't ready to hear that yet. They want certainty. They want narratives. They want someone to tell them, everything's fine. This dip is healthy. The Fed has it under control. Newsflash. They don't. This is what makes contrarianism so uncomfortable. It feels wrong because you're alone. You're buying when everyone else is selling. You're investing in boring, unloved assets while your friends are bragging about their new AI stock that's definitely going 10x. But here's the thing. The crowd is almost always wrong at the inflection point. And if you're waiting for the price to move before you act, you're too late. That brings us to silver. If gold is suppressed, silver is chained in the basement. And yes, I still believe the West has lost control of gold pricing, and China is now in the driver's seat. China doesn't play by Western rules. They accumulate quietly, they don't report transparently, and they understand that rising gold now benefits nobody. Not until the table is set. You want to know what's really happening? Gold is being accumulated into weakness. The price is kept in check not because there's no demand, but because there's too much. The suppression allows accumulation without triggering panic. It keeps the crowd distracted. In China, they're not just passively watching, they're helping. They've learned to use the West's paper system against itself. By shorting the paper price during periods of tension, they can buy more metal on the cheap. And they're not just doing it through official channels. They're buying door bars, mining concentrate, refining their own supply chain, and building what's effectively a shadow reserve system off the books. And they're not alone.
Silver is still controlled, no question about it. But when you talk about, in terms of the amount of silver that's being accumulated here in the United States, since Easter, at least almost, and I haven't updated it since last week, but since Easter, about 12,000 silver contracts have been delivered. That's almost 2,000 tons of silver. That's not a small amount, and it's not, that's something that should be understood and not glossed over, because the price has not done what it's supposed to do. And I think, people get so tired of hearing that because it's been that way for quite some time. They perhaps are becoming disenchanted, but yet there's money here in the United States at a higher level that understands what's happening, that is standing for delivery in quantities that we've never ever seen before. I think that, to me, is one of the biggest things that I would focus on. And in so far on the May contract in silver, which is an active delivery month, there has been, let's see here, it's record pace. So far, as of Friday of last week, 13,581 contracts have been delivered. That's an all-time high. And one of the things that is unusual about it is that almost 3,200 contracts, about 16 million ounces, were delivered from the banks to non-banks. Now, We're not seeing the same thing with gold, where banks are delivering as much to non-banks. I don't know when QE doing, I don't know how far back we go on this, but over the last year or two, the banks have quietly offloaded over 110 million ounces of silver to non-bank entities. Who are these non-bank entities? I'm not quite sure. To me, this screams that institutions like the banks are frightened of silver and maybe are getting out, while others, the industrials or military industrial complexes, standing for delivery on all of this stuff. You can only hold down the price of any commodity or manipulate it over an extended period of time by pushing it in the direction that it is going. You have China doing interviews with Sean Kunkun and others in the resource space have said to me, Andy, China buying all throughout South America, in particular Peru, and they're buying up all the doré and the concentrate. The doré are crudely refined bars, and the concentrate is a byproduct sludge, paying double what the West will, and sending it back to China for refining. Well, why would the second largest producer of silver in the world need to do that? Buying this stuff and then sending it back, paying over market price and sending it back for refining. Well, it disintermediates the market, disintermediates the price. No one knows how much they're buying, and they go to the source. Russia says, well, we're going to add it to our strategic stockpile. India has bought over 900 million ounces in the last 5 years, probably more than that. That's just what we can calculate. And so you have massive money that has been using the suppression. If you look at the LBMA, David Jensen does an amazing job of talking about the rehypothecation there. And even though the numbers that I'm going to give you are a little lower because of all the deliveries, last month they had, in essence, 800 million ounces. Now it's down to 7 something now. But 800 million ounces was the entire stockpile of silver at the LBMA, of which 500 million was encumbered by the ETFs, like SLV, like Bullion Vault, leaving 300 million ounces, and the number was 290.
Let's keep going, because the part most people miss, the part no one wants to talk about, is that this game isn't just about supply and demand anymore. It's about perception, about weaponizing psychology, about controlling not just the price of gold and silver, but the very idea of gold and silver as legitimate money. They know what they're doing. Every time there's a war scare, a debt ceiling crisis, a banking failure, what should happen? Gold should surge, silver should spike. But what actually happens? The price drops. Paper contracts flood the COMEX. Momentum traders pile in the wrong direction. The public gets confused. And then the crowd says, "See? I told you gold was dead." That's the trap. Because underneath the surface, something very different is happening. Central banks are buying gold at the fastest pace in 50 years. Russia's adding to its reserves. China's importing more gold from Switzerland and Hong Kong. Turkey, India, Kazakhstan, Uzbekistan, all stocking up. Sovereign wealth funds, family offices, even state pension managers in the East are reallocating into metal. They're not doing it for performance, they're doing it for protection. Why? Because they know what's coming. This isn't about inflation anymore. It's about trust, or more specifically, the loss of trust in fiat currencies, in the dollar system, in Western debt markets. The US is barreling toward $40 trillion in debt. Rates have risen, but inflation isn't under control. And the Treasury market is being hollowed out. Foreign demand is drying up. The Fed is boxed in. If they keep hiking, they break the banking system. If they cut, they admit inflation's not dead. Either way, the system is unstable. The math no longer works. Now we can argue over timing. We can speculate on the next Fed pivot, but the structural story is written in stone. The world is moving away from US Treasuries and toward hard collateral, and the asset of choice for thousands of years is gold. But where does silver fit into this? Silver is the leverage play on gold. It's not just an inflation hedge, it's a monetary pressure valve. When the gold market becomes too tight, too crowded, too obvious, silver explodes. That's what happened in 1980. It happened again in 2011. And it's setting up again right now. But silver doesn't move first, it lags. And that lag is where the opportunity lives. Think about it. Gold has moved from $1,200 to over $3,200 in less than a decade. Silver? still hasn't broken its 2011 high. In real terms, it's cheaper now than it was 40 years ago. That's not just mispricing, that's a distortion, a result of years of manipulation through unbacked contracts, fractional lending, and rehypothecated supply. But the wall is cracking. More and more silver is standing for delivery, not just on the COMEX, but across Asian exchanges, industrial procurement platforms, and sovereign contracts. Vaults are being drained, allocated accounts are tightening, and the EFP mechanism, the old paper-to-physical escape hatch, is backfiring. Instead of moving liabilities off the books, it's moving metal out of the system, for good. And the really smart money, they know this. They're not buying silver ETFs, they're not buying COMEX futures, they're buying bars, 1,000 ounces, kilos, monster boxes. They're taking possession. Why? Because they don't trust paper promises anymore. And when the paper fails, as it inevitably will, silver won't rise gently. It'll launch. But here's the catch. It won't be available. You think premiums are high now? Just wait. When the break happens, when there's a failure to deliver, when a major player can't settle, when a bullion bank admits the cupboard is bare, you won't be able to get silver at any price that resembles today's. Dealers will go allocation only. Mints will be backlogged for months. Spreads will widen, and the paper price will disconnect from physical permanently. At that point, it won't matter what Kitco or CNBC says. The free market will set the price, and that price will be based on real demand, real delivery, and real scarcity. So what do? You act before that moment arrives. Not when the headlines hit, not when Jim Cramer suddenly discovers the silver market. You act now, when the tape looks boring, when the price is being leaned on, when everyone else is distracted. That's when the best trades are made. And let's not forget the macro backdrop here. We're watching the dollar face the first real challenge to its global reserve status in our lifetimes. BRICS are setting up cross-border settlement systems. Saudi Arabia is flirting with yuan oil contracts. Russia is settling in gold. India is bartering grain, energy, and precious metals. The global plumbing is shifting, and gold and silver are the pressure release valves. But here's where it gets personal. Most Americans, most Western investors, still think they're insulated, that this can't happen here, that our system is too stable, that our markets are too deep. That's denial, because every fiat system in history has eventually failed. Every empire has overextended. Every currency based on debt and confidence has collapsed. And the US dollar is no exception. We've already seen the playbook. It's called Bretton Woods. It's called Nixon's gold window. It's called the Plaza Accord. Every one of those moments was a reset, a reorganization of power, trade, and money. The next one is already unfolding, and this time you won't get an announcement. It'll happen in stages, quietly, through liquidity tightening, through delivery defaults, through geopolitical ruptures, until one day you wake up and the gold price isn't $3,200 anymore. It's $5,000, then $8,000, and silver, triple digits. No pause, no retrace, just air, and then the headlines catch up. So what's your exit strategy? Because this isn't a trade, it's a generational pivot. The people who understand it now will be the ones holding real assets when everything else reprices. The ones who laughed at gold bugs, they'll be the ones begging for allocations, but there won't be any left. So here's the bottom line. Don't wait for the price to validate your instincts. Don't wait for permission from Wall Street. Don't wait for CNBC to tell you it's time. Trust the flows, trust the vaults, trust your common sense. The game is rigged, yes, but the end game is not. Because when the paper burns, only metal remains. And we're almost there.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.